Let's discuss some more on how the global markets are trading right now, where emerging market picture stacks up, and a special voice is joining us on the show today. Noted global fund manager Steve Birch is visiting India right now, and he joins us on the show. He's been working with the noted brokerage, the American brokerage William O'Neill, which is expanding its operations in India now gradually for the last 24 years, currently as president. But over the last 24 years, for almost 20 years, he was also participating in managing the family office of William O'Neill, where he has clocked almost 28% kind of returns for a prolonged period of time. Steve, good evening. Thanks a lot for joining us on the show. US markets first, they are trading at almost record levels. Do you think they are pausing now or losing steam? Is there a correction looming around the corner? Or do you think after spending some time around these levels, they may start building on the gains made? Because after all, the bull market has lasted 8 years now.
That's a great question. Many people were concerned about the outcome of the election. The market then responded and it rallied very strongly. We have a proprietary technical signal that's based on looking back over the prior 27 market cycles in the United States. And we got a signal that we were entering a new bull phase in January, and that signal has not changed. So we remain very bullish on the market. The nice thing about this proprietary indicator is it eliminates all the opinions, all the biases that people can have, and it's very, very quantitative. In the last 4 weeks, that signal started to show some weakness, but not to the extreme that we were warning clients that they needed to exit the market or be concerned. So as it stands today, we are still very bullish on the US market.
So if one were to talk about the S&P and the Dow, what are your models telling you about the levels they can achieve over the next 1 to 2 year basis? Any levels to watch out for?
The indicators are interesting in that they don't project a particular level. They just tell you the state, whether the market is bullish or bearish. It's very, very simple. We tend then to look at individual stocks to try to understand whether the broader market is really acting in harmony with that general signal. And we still see that. Many leading stocks in the United States are still very strong. They're showing good earnings growth, very strong revenue growth. It remains to be seen how this administration implements its policies and how that affects earnings of various companies and industries. But we just stay bullish. That means we're not looking for any particular target. We're going to let our profits run, and that's an important part of our process. And if we're wrong, if the market turns for some other reason and our indicators tell us to start to exit, we will reduce our exposure.
What's your overall view on risky assets, global assets, fund flows? Do you think will continue to pour in?
Well, the beautiful thing about using a quantitative approach that really allows you to eliminate biases is regardless of policy, central bank policy, political policy, the market itself, the thousands of participants that are bidding and selling stocks every day, they really set the agenda. And we see that in stock prices. We see that in our quantitative indicators. So right now, across the emerging markets that we look at, the majority of them are in a very bullish state. Now, I can try to tie that technical action to, well, is it because of policy or is it because of this? But it's very hard to know exactly what it is. We just see in the composite how investors are reacting, and things look very, very bullish.
Right, what about emerging markets? What are your thoughts there? Emerging markets have been outperforming DMs.
I think it can. I think that in general, emerging markets are they're more speculative. There's more volatility, but there's also much more excitement when you compare to a developed market. The United States is a very, very mature market. Some of the opportunities there are while we might know the companies, they don't offer the same kind of growth rates, the same growth opportunities you'd find in the emerging markets. So I always challenge our analysts to really scour the world, pay close attention to these younger nascent markets, because that's really where I think there's some exciting opportunities.
Right. Steve, you are visiting India right now. You are in Mumbai. What are you making of the financial markets here? We are also almost at record levels. On the broader side, we've been maturing because the number of offerings in the market and its depth has gone up. How do you see the attractiveness of Indian markets?
Well, I think all those are valid observations that the Indian market is maturing. It is getting broader, it is getting deeper, and that's good for investors. There are particular things that I'd like to see happen in the Indian market: more transparency in terms of financial reporting. It is frustrating to find or hear about a great story in India and then to go look into the numbers and you can't get good data. That's very frustrating as a global investor. But the Indian market in general, it's interesting. It had a strong follow-through day in January of this year, very similar to what we had in the United States. It's been in what we call a confirmed uptrend, so we've been bullish on the Indian market. We have no signals today, as on this date, to tell us to get negative or to be cautious or scary. And we're seeing some interesting opportunities in different spaces. Not so much technology like we might see in the United States, but in some cyclicals, some chemicals, some adhesive manufacturers, some cement manufacturers. So India is a burgeoning economy, and it really can serve investors well to pay attention to those companies that are growing their revenue and growing their earnings.
Well, your observation is right too. Chemical stocks, cement stocks have been doing very well in India lately. You're expanding your operations and business in India. What's the longer term view you're taking, and what's the plan here?
Well, we are most excited about what we see happening in India and in China when it comes to the demographic and the young people that are working in both countries. We are expanding in both China and India, and we see an enthusiasm amongst the young workforce. They're very clever, they're smart, they are learning how to both build wealth and manage wealth. And as a result, we are taking some of our legacy, 30-year-old excellent best-of-breed software, apps, data, and localizing them for the Indian investor. Because you have a burgeoning middle class, which is very, very exciting for us. We think the long-term demographic secular trends are in our favor. We see these changes in the capital markets. We've been in the US market for 54 years. This is a long-term view for us, investment. So we think it's a very, very exciting opportunity to be participating in India, setting up an operation and offering our research and services.
All right, over the next 4 to 5 years, where do you see the Indian markets headed?
Well, back to my prior statement, I am longer term. If we were to look at an annual chart of India 10 years from now, I would expect that to go a lot higher. Now, why? Because it's really because of this innovation, this growth, this burgeoning middle class and this demographic. That secular wind at our back is very, very hard to stop. So I'm very, very bullish India long term.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.